Welcome to the President and CEO Focus on the Middle Market podcast series, where President and CEO Founder Paul Stukel discusses middle market issues with business leaders from across the nation. Today, Paul speaks with Bruce McCain, Chief Investment Strategist and Senior Vice President at Key Private Bank. They discuss KeyBank's most recent economic outlook and its middle market sentiment survey showing increased optimism from middle market executives.
You know, the reports seem to be pretty optimistic, regarding the state of the economy in general. Certainly, overall, sort of, what are your thoughts on where we're going here in the U.S.?
Well, I think that particularly in the U.S., we're in what we would define as the sweet spot of the economy. In the early stages of a recovery, you have a lot of uncertainty about whether it's going to continue. You may have a little bit more rapid growth. But at this stage, everybody's pretty well convinced that we're solidly in recovery, and you can see the momentum of economic growth propelling the economy forward for at least some time into the future. Unemployment has been reduced to the point that people that have jobs, for the most part, that want them. At least a lot of people who've been unemployed have them. And there's just a rising confidence about the economy and where it's going. And yet typically you've not quite gotten to the point that high levels of inflation are worrisome to businesses and individuals, and the Federal Reserve does not feel compelled to be stepping on the brake to bring the economy down. So that's the sort of period that we see. It's not been strong growth by historical standards, but the probability of growth and the probability of being able to find jobs and some of the other things we need to live our lives have improved markedly and defined what feels like a pretty good period of the overall economic cycle.
Yeah, it's. I was noticing in the numbers, the pretty decent, GDP growth. I mean, 3% is not a bad number. We've had that for a couple quarters now. But the earnings growth is sort of far outpacing that, which I thought was interesting. I mean, to what do you attribute that?
Well, unfortunately, part of it is just poor comparisons. When you look back over a year ago, we were still in the slump that was defined by the slowdown in the energy patch. And so to some extent, as we've bounced back from that, the corporate earnings have been able to grow much more rapidly than the economy. Going forward, those comparisons will get a little bit tougher. It'll be harder, therefore, to have the sort of superlative growth that we've seen over the course of this year, at least a high level of growth. I mean, superlative, even by historical standards, may be a little bit of a stretch. But from that standpoint, it's certainly been a better time for corporate earnings. That has helped to justify a lot of the increase in equity prices. Going forward, it won't be quite that good, but again, it comes back to the probability that in a growing economy that you'll have growing earnings are pretty strong, and so the prospects for the most part are pretty good for the next year or so.
Yeah. I guess that makes sense. It's sort of working from a lower base, I guess, is the way to look at that. Yeah, in terms of inflation, it's been so tame for so long, and we seem to be seeing some wage growth at last, at least from the most recent numbers. I would have expected a little bit more inflationary growth with those numbers rising. Is that just a delayed factor? I mean, do you see that sort of percolating through and bumping up inflation a little bit, or no? I mean, the Fed clearly doesn't. So, what do you think?
I think that there is some evidence that it's beginning to get a little bit stronger on the wage growth side. And at some point you would think that probably would work its way through. But I do think that part of what's kept inflation low and what will keep it slower than it's been in the past comes out of the general oversupply of manufacturing capacity in particular that tends to be somewhat a global issue, and the general impact of globalization itself. We peaked at capacity utilization in the United States at about 79% this cycle. Historically, that's been in the mid-90s. If you go back to the 50s and 60s, we just have a much more competitive environment, especially for manufactured goods, but to some extent for labor in general. There's been such a focus on trying to remain globally competitive that it's made it very difficult for firms to pass through price increases on the products that they're selling. And that hasn't changed. Labor has certainly tightened up dramatically, but with low productivity growth, firms have to pay any wage increases more out of their own bottom line. And given that that's been pretty tight for many firms, there's just a real reluctance to be too aggressive with wage increases. So I think that it'll be prolonged. Inevitably, supply and demand does make a difference in terms of prices paid, but it's probably going to be much slower coming than we might have thought based upon just an a priori look at the overall markets, given the general impact of globalization and the competitive environment for what firms are selling.
Yeah, interesting. You know, I guess sort of related to that, we see there's been this recurring problem that seems to be getting worse, actually, rather than improving, and that's the lack of qualified workers, at least here in the U.S.
Yes.
I mean, this has been a recurring theme, and it's you know, there doesn't seem to be an answer to it. I mean, what are your thoughts on that? I mean, is there any hope on the horizon for that? I mean, because it seems to be getting more acute rather than lessening.
Well, I guess it depends upon how long your horizon is. There are sort of two impacts here. Number one, certainly we've reached the point of the cycle where we're much more constrained with respect to labor than we were early, just a few years ago, and that's quite normal. You often see that. And I might add, although there's the general impression that that's particularly for skilled labor, that we have an excess supply of the lower rungs of the educational spectrum, the numbers suggest that's not in fact true. That those without in other words, just a high school education are about as low in relative number of people looking for jobs as we've seen at the low points in previous cycles. So certainly the cyclical effect is part of it. The other part of it, though, is demographic, much longer term. It's the retirement of the baby boom. The midpoint of the boom years where it was 1955, those people will turn 65 in 2020. The statistics tell us that something like 10,000 people a day are retiring, and that is such a massive portion of our society. In 2040, there were roughly 4.4 workers or 4 working-age persons in the society for each person in 65-year and older category. By 2040, that will be cut almost in half to 2.3 to 1. It's a massive transformation of our workforce, and we're almost halfway through that. So it's a little hard to tell just how much that is having an impact on our current dilemma in looking for people to fill jobs. But inevitably, if you're about halfway through that massive transformation, one would think that it's probably having a fairly large effect on the workforce and making it much more difficult for firms to find the people they need.
Yeah.
As to hope for the future, the problem with that is that either wages need to rise enough that it attracts some of those who've been retiring back into the workforce. You need to increase immigration or some other element of expanding the number of people, or you need to make your workforce more productive. And I think over the long term, the third source of improvement will be the biggest hope. But that means that we need to get the technology for driverless cars, driverless trucks, some of the artificial intelligence applications, and some of the other things to the point where they're commercially viable. And then we need to make the investments to implement that within the workforce, and that's simply going to take some time. So there is hope longer term, but it's going to take probably a number of years to be able to really ameliorate that. And you probably need to see quite a bit of wage increases before it becomes more profitable to do that, and you start seeing the workforce make that transformation more rapidly.
Yeah. It's interesting. I mean, the middle market CEOs that I talk to, they're actually they're dying for skill, what they call skilled workers. So they don't need a college education, but they need to have usable skills, machinists, things like that. And there's almost a training element there that is missing.
Yep.
I mean, everyone's going to college as opposed to going to trade school, as it has been in the past, and that's it's an interesting challenge. It's kind of an unusual challenge, and in a time where everyone you want to the employment situation looks pretty good right now, but the wage situation hasn't been so great. You just got to expect that's got to adjust at some point, but. It's interesting.
And there will be some adjustments. We have a client who actually set up their own trade school to employ the staff that they would need as they looked for that. Certainly, we're going from the marked transformation that we're seeing is from the labor excess that we've had really for 40 years and more as the boomers were incorporated into the labor force to marked labor shortage. And we're just not mentally prepared as businesses to really anticipate all that's going to mean. Not only training the people we need, but changing some of the policies to make it more attractive for people to remain employed or to sign on with firms will probably be a much bigger element of defining the winners and the losers in the economy that we'll see going forward.
Well, yeah, and you touch on a demographic issue there too. The millennials. I mean, they're kind of different.
Yep.
Everything I've heard, and as you say, in terms of enticing people to sign on and making it worthwhile. I mean, millennials are pretty stubborn, actually, when it comes to those things.
Well, each generation has its own, but I think that realistically we've been in a buyer's market when it comes to labor for most of what we've known in our lifetimes, and it's going to turn into a seller's market much more markedly than we might anticipate. And that's really going to take a definably different mindset, I think, to manage workforce of a company or a small firm relative to what we've seen over the last 40 years. So clearly changing times. So, and that, again, is impacting where we stand with respect to the availability of labor, the ability to grow our economy in general, and ultimately will play out through what we see in wage rates.
Right. So drilling down a little bit more to the middle market companies, as is typical, at least I've seen in terms of the various surveys that are done, they seem to be much more optimistic about their own. Much more optimistic about the U.S. economy, and then even more optimistic about their own respects. And I think that was borne out in your report. But what do you think drives that? I mean, is it because it's company specific? Are they happy about the tax and regulatory situation, demand? I mean, what are your based on the surveys and your own experience, and what's driving the optimism these days for the middle market, other than just sort of general economic growth?
Well, I think that a large part of it is where we are in the cycle, the fact that things have improved. But I think that the other part of it, too, from a psychological standpoint, we went through a horrendous downturn the last time. And while that has shaken the confidence of a lot of businesses as we went through that, I think a good many of them, simply by virtue of relief at what they've seen and then pick up in their businesses, are feeling markedly better than they might have been other than that major scare. You know, as much as it hurts to pound your head against the wall, it feels so much better when you stop that you may feel euphoric relative to what it had been if you've never gone through that adverse experience. And I think there's some element of that in the recovery this time. Businesses that thought they would be out of business now are doing much better. They feel on more solid ground. I think that relief has helped to improve sentiment relative to what we may have seen in past cycles. Certainly, too, there was a lot of hope out of the last election that we would see some improvement with respect to some of the operating conditions, and to some extent, I think especially on the regulatory side, to the extent that it was influenced by executive orders, you're getting some of that. And then the other part of it, too, is that we're seeing from the U.S. standpoint, we've certainly seen improvement in the U.S. economy, but now we're seeing it in the global economy as well. And the general pickup globally, I think, is not only improving demand for U.S. products, but it's also helping to stabilize the U.S. recovery and the prospects of continued growth relative to what it would be if the U.S. was still growing and most overseas markets looked like they were on the verge of recession. It's just over the last year and a half, the global situation, perhaps in part because of the falling price of oil and the fact that that's so important for Europe, Japan, and some of the other developed economies in particular, has made it a much better outlook from a worldwide standpoint.
Yeah, I mean the fuel, the oil price is it's such an interesting dynamic because it almost seems to me as if it gets too low, the energy sector is so important. The energy sector starts dragging a lot of problems in. If the price is too low, and of course if it's too high, all the folks that use the oil get whacked. It's a very interesting equilibrium there. I mean, leaving aside all the geopolitical stuff, it's an interesting. I've always found that to be a very interesting dynamic. So in terms, okay, I'm going to put you on the spot here and it's not fair because we're right in the middle of it. What are your perceptions as to what's going to happen in Washington with respect to taxes, corporate taxes in particular?
Well, to some extent, we've kind of reserved judgment and tried to let the dust settle because there's just so many political elements to the debate back and forth. I think almost certainly there's enormous pressure to reduce corporate taxes at the margin, and I think that will happen in part because we're so dependent upon what that does to the tendency for U.S. firms to use inversion to incorporate overseas and the potential loss of jobs in the United States. A lot of the focus of the tax bill has been in trying to match more closely what you see in overseas circumstances, not only bringing down the default rate on taxes, which a lot of corporations don't pay, but the ones that do then have enormous incentives to take their operations overseas, and you want to try to avoid that, but also move to more of a territorial system that matches what you see overseas, and in general become more competitive. The problem is that obviously we need to keep the deficit from ballooning. Both sides of the aisle seem to be focused on that in the debate, and that means that as you do try to make the changes in the tax code to become more globally competitive, somebody has to pay the bill, and that's where it's becoming a little bit more ticklish. Do we eliminate state and local income tax deductions? How much do you limit the mortgage payment deduction on the itemized deductions? How much of it will come from eliminating the ability to lever up as a firm by limiting the interest deduction? All those are the sticking points that are playing out in the political debate, and we'll just have to see where they settle. But I think net, given that it's a Republican-introduced measure, in all probability, it will be somewhat more friendly to business, particularly from an international standpoint, and somewhat less friendly at the margin for some of the high-income deductions that people take advantage of.
Right. Bouncing over to the M&A market or the expansion through acquisition. In the report, in the most recent survey, I believe the number is 70% of companies are considering an acquisition in the next 6 months. And you know, there's been for a couple of years here this anticipation, and that driven by baby boomers, you know, who own their own company, retiring, and therefore wanting to sell their business. There's a lot of money on the sidelines in private equity, and there's also a lot of private equity firms that are sort of reaching their 5-year window to start cashing out. All these, and then low interest rates. All these factors seem to have sort of coalesced into this, you know, estimation that there's going to be this massive M&A market, a lot of activity. It hasn't quite come to fruition in that way. I mean, do you sense that, at least in terms of the middle market, that the M&A activity is going to really catch fire here? I mean, it sounds like it from the business sentiment report, but what are your thoughts on that?
Well, I guess the premise that it's going to catch fire is a little bit hard to define. I think it certainly will pick up. There's a lot of pressure for it. Several things are pushing that direction. Number one, a lot of firms are really not anxious to build new plant and equipment because they often are competing in industries that are already oversupplied from an aggregate standpoint. So the appeal of defining a buyout of a competitor in particular, or in some instances going into a new area, seems much, much more attractive. The sticking point has been that prices are high. And the reality is that prices are high for virtually all assets. Certainly equities are high from a historical standpoint. Bonds are even higher. Recently on a tour through the western states, they were talking about how overpriced Idaho farmland is. And part of the dynamic is that there's a great supply of boomers and with smaller firms that ultimately want to sell. But I think to some extent there's an even greater supply of boomers on a global basis that have set money aside for their retirement years, looking to invest that. And so as you indicate, through private equity and other sorts of vehicles, there's more money pouring into some of these areas than there had been historically. And I think that part of the problem, therefore, becomes for small businesses that ultimately want to make the transition, they're reluctant to sell out too quickly in the hopes that they can get a higher price, and sometimes their aspirations exceed even what the markets will allow. So I think that as you get closer to the point where boomers need to make a transition simply by virtue of age, you probably will see an acceleration of the sale of smaller businesses owned by those individuals. Whether or not the price accelerates or whether or not the numbers catch fire, as you put it, in a massive move, I think is a little less certain. But I think inevitably the passage of time, and especially the aging of the ownership, suggests that we're going to need to make more of a transition than we've seen to this point.
You know, in close, Bruce, what's your outlook for the next 12 months? I mean, how do you see the U.S. economy and the global economy developing in the next 12 months?
We think that the general sweet spot we've defined by strong probability of growth, virtually no sign of recession at this point, suggests that the next 12 months will be pretty good. In fact, perhaps very good, feel very good, and be decent from a standpoint of growth. I think the other thing is that everything we've seen suggests that inflation will be slow to come to fruition. And with that in mind, probably the Federal Reserve will be relatively contained in the way that they raise interest rates. So I think that the general period of good times that we've seen, high positive sentiment, not only will continue through this stage of the economy, but perhaps for much longer than normal, and make this a pretty good period when it comes to both investing and also running businesses and general economic growth.
Be sure to check back for the next episode of President and CEO's Focus on the Middle Market. Thanks for listening.